Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So the stock market rally that we've had since October continues. Over the past couple of weeks here, we've had the markets remain just below this level of resistance right here. And what we're actually seeing right now is that smart money has been exiting the markets in these last few trading sessions. We're going to take a look at indicators that show us that the same traders who timed some of the biggest tops and bear market rallies and corrections in recent financial history are currently betting on downside again. We're going to take a look at why that is and what it means for the market. Don't forget to click on the subscribe button if you are new here, and of course smash that like button if you enjoy this video. Now without further ado, let's get right into it. So first of all, let's look at this chart here. This is the OEX put call ratio. Now OEX options traders actually have a very good track record at timing tops in the stock market. Typically, the put call ratio is actually something that you look at as a contrarian indicator, but the fact that this is OEX options means we're looking at an entirely different data set that actually historically times the market beautifully. So let me show you guys a quick backtest of this indicator so that you can have a feel for what the timing of these traders looks like. You can see here, for example, in the 2000 era leading up to the 2000 tech bubble top, before the vicious bear market that we had between 2000 and 2003, you had a lot of these waves here, and you can see they didn't time the market perfectly, but when you had a surge in the put call ratio, it most likely meant that upside was limited and that you had increased odds of seeing a correction. You can see here again, right here in June of 1999, you had one more thrust up, quite a severe correction here in 1999, and you can see it almost at the very top of the market. Here in January of 2000, you had this put call ratio spike to the highest level in history right here. And a few months later, you had the top of the market before a 3-year bear market. Now you can see what the put call ratio looked like at the bottom of the bear market. It was very low. So short interest of these smart money traders, we'll call them, was also very accurate at timing the bottom of the market right here. If we take a look at the 2007 bear market, we actually have a very similar structure where short interest was actually building up, leading up to the very top of the market, where it stayed elevated here throughout the entire bear market topping pattern in 2007, only to hit record lows here in 2009 at the very bottom of the market. So again, a very impressive performance in 2007 from these OEX traders that were also able to time corrections throughout the entire bull run here between 2009 and 2018 here. Look at this 2011 big correction. Might not look like much on that chart, but that was a very violent drop in the market where OEX traders were betting on downside before this massive almost 20% correction on the stock market. You had the same thing happen right here in June of 2015, where you had one spike before a quick drop, and then another spike right here in December 2015. You can see where those are on the chart of the SP 500. June 2015, quick 12% drop, and then December of 2015, quick 12% drop again. If we look at how they timed the COVID bear market, look at this, where short interest was right at the very top of the market here in February of 2020. These traders were betting full on like they had never been before on downside in the stock market, and they got it right. Again, let's look at the 2021 top before the big bear market in 2022. Of course, these traders were betting like they never had before throughout this entire period. Then in August, right here, August 2022, big spike in this put call ratio, marking the exact top of the market once again. Now you can see here, ever since around October of 2022, we had this put call ratio stay very, very low, not much movement as the market was rallying, no warning signal from this indicator telling us that smart money was betting on downside in the market. Now look at what's happening. a big surge in this put call ratio as these traders are once again betting on a reversal in the market, not on further upside. And what's interesting is that if you look at dumb money, so we'll call this the normal equity put call ratio that usually times fear and greed pretty successfully, you tend to have the exact opposite behavior to the OEX traders, where you actually see this ratio get very low near tops in the market and very elevated near bottoms in the market. Like here in December of 2022, put call ratio was spiking, market was bottoming, and the markets went on a big run here throughout the month of January and February, only to see traders once again pile into call options, bringing this ratio all the way down into the zone of greed, marking the top back in February. And you can see where we've been since about the 30th of March. Right here, we've been in the complacency zone that has marked all the big tops throughout 2021 and 2022. You can see here November of 2021, lots of complacency right before volatility began and ultimately led to the top in January. In March of 2022, here complacency getting back into the market, timing that exact top in August of 2022 again. So dumb money is piling into the market and smart money seems to be betting against the market right now. Now, if you actually look at the core inflation rate in the US, the last reading we got was actually higher than the previous one. So there's all this talk about inflation coming down very quickly, and that's a thesis that we loved in 2022 because oil prices were moving down very quickly. But you look at the core part of inflation that excludes food and energy, and you actually see that inflation is quite sticky and is not necessarily breaking down the way the Fed wants to see, like it did here in the 1970s. So even in the 1970s, that is now considered to be a mistake, a Fed policy mistake where they eased monetary policy too quickly in response to the fact that inflation was coming down. We're not seeing that today. We're not seeing this type of breakdown yet. And yet the market right now is pricing in the best case scenario where the Fed pivots, inflation goes down, and we don't see an earnings recession. Analyst estimates for earnings are very optimistic, and that's the second big factor that the market currently is disregarding. There's more and more evidence that we are indeed heading into a recession. You can see here, this is the recent NFIB small business survey. So the number of businesses that are currently reporting that credit was harder to get than the last time around is surging here. It surged in March. And you can see here in 2007, and you can see how similar that looks to previous recessions. This is what happens leading up to a recession here, gray bars being recession. You have credit that tightens, and that's reflected in these surveys, but it's not yet reflected in the actual economic data and the financial markets that have yet to price in the recession that is coming. This is our big bet right now, that the markets are going to be pricing in a recession throughout the next few months as economic data deteriorates. But the portfolio that we have on Game of Trades is constructed in a way that is going to perform extremely well, regardless of whether we get a wake-up call from the Fed that pulls the market down because inflation is too hot, or if we begin getting weaker economic data as we do head into a recession. If you're interested in knowing more about our macro strategy and stay up to date on all the decisions that we make, you can test out our service for free by clicking on the link down below and signing up to our service. Now, that's about all I wanted to cover in this video. I hope you guys enjoyed. If you did, don't forget to smash the like button and click on that subscribe button. And now, in the meantime, I wish you good luck on your trading and see you next time.